what's up everyone? Kirk here again at Option Alpha. Just tuning in here while the girls are sleeping on the camera, which is good. So hopefully they don't wake up during this live stream. But I want to talk about two different things today. And so first thing that we're going to talk about is why a bunch of people got really mad at me last week. And I know seems like I'm excited about that, but I kind of am because I know I'm pushing somebody's boundaries and limits, which is good. So we'll talk about that. And then I want to talk about the reason, like the topic that everyone got kind of mad at me, or some people got mad at me about, and kind of go through why, like what the answer is to this whole discussion about short call dividend assignment risk, which comes up again and again. And it seems to be something that, like I guess Halloween and witches for me freaks people out because, brokers, I think, just freak people out on how they do it, right? So if you're tuning in here and you have questions about that, just let me know. And also just let me know where you're from in the world, because I see some people tuning in here right now. Cool. I want to see where you guys are from. So the first thing is first, right? So last week, a bunch of different securities, XLV, which is an ETF in the healthcare industry, and then XLF. And some of these other ones had dividends that they were going to get paid, right? And so we were trading options around these. And we had some at the money strikes that were now in the money. So we had, call options that were going in the money. And all the brokers sent out these alert messages to everyone that said basically, hey, you've got an option that's in the money. It's at risk of assignment. Now, in all defense for them, they have to do that, right? They have to send you out that email or that message that says, hey, we could potentially, you could potentially get assigned here because you've got a short call. And the only reason being is that if the call buyer wants to get paid the dividend, then they might assign the stock, right? And they might buy the stock from you as the short call option seller. And so brokers have to do that to send it out. But the problem in doing that is that they freak a lot of people out. And so we got a lot of people who emailed back to me, right? And I get all of them, right? Like I know as soon as it happens to me, I'm going to get like a flood of emails. And so everyone emailed back to me, and or everyone who I guess who's new to Option Alpha hasn't been through this process before, emailed back and they said, hey, what's going on? What are we going to do? Are we at risk of assignment? The whole, slew of questions. And to every single person, I basically replied hey, there's a video quickly. I think it's 4 minutes or 5 minutes inside the website. And I pointed them to the right direction, either send them the link or send them to the page. I said, look, there's a video in there. Go watch the video and figure it out for yourself, right? And not hey, you got to go, watch the video right now. But hey, if you want to learn how to do this, go figure it out and see if you're really at risk of assignment. Now, the easy thing for me could have been to obviously say to them, yes or no, we're not at risk of assignment, right? I could have replied back to everyone with 2 words and said no. But instead, I chose to reply back and point them in the right direction so that they could go learn how to fish by themselves. And I think this is an important distinction because a lot of people actually got mad that I didn't reply back to them. But I would be serving them no purpose, nor would I serving you any purpose if you're listening to this right now and watching on the live stream, if I didn't at least teach you how to fish and teach you how to do it by yourself, right? So 2 minutes of your time could have taught you how to learn if you're at risk of assignment. Now, we're going to go over that here in a second so that you know. So if you're watching now, you can learn too. But 2 minutes of your time would have taught you if you're at risk of assignment for the rest of your freaking life, right? So why, I can be the inhibitor, if you will, and you'll be more, reliant on me in the future, which, could be good, could be bad, right? But I don't want that. I want you to learn how to do this by yourself, right? So that's why people got really mad at me and said that, right? And so, yeah, and I think it's, not as intimidating as it once was. So someone said, it happened to me just recently, and it's not, right? It's not that bad. If you get assigned, you get assigned. If you're at risk, you close. If not, whatever, right? But I think the key here is just to take a little bit of, self-awareness and motivation to learn how to do it by yourself. And so if I ever push back against you, if you send me an email or send me a message or something, and if I had to push you in the right direction, it's honestly out of love. I want you to do it for yourself and learn how to do it. And because then you can learn how to do it. You don't have to rely on me to do it or rely on somebody else, right? So so that was interesting and fun, and had to deal with quite a handful of emails of people why don't you, just tell me the answer, GD, blah, blah, bleep, 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 bleep. I wish I could bleep out the messages I got. It's kind of ridiculous, actually. But I told people this is why I do it. So talking about short call dividend assignment risk, right? So now let's actually talk about why this even happens, right? And why you can determine basically if your short calls are at risk of assignment. Yeah. So the first things first, right? So if you are a call option seller, you're at risk of assignment if your option's in the money by the time that the dividend gets paid, the ex-dividend date basically. or coming up on ex-dividend date. Now, why would this be the case, right? So first of all, you have to put yourself in the shoes of basically an option buyer, right? So you got to put yourself in the shoes of an option buyer. So if an option buyer has a position, they have defined risk, right, below a strike price and an infinite, air fingers quotes, infinite possibility for return. So if they're going to exercise their call option, logically exercise their call option, right, then they would want to basically exercise their call option and then get themselves into a position where they get paid the dividend to mimic the call option position that they have, right? So if you think about the payoff diagram of a long stock goes from bottom left to top right, right? Straight line. So if they exercise their call, they're basically now dealt with long stock. They bought stock. And that's not the example, or that's not the position that they wanted to be in the first place. If they would have wanted long stock, they would have bought long stock. But they were a call option buyer, right? They wanted defined risk on the bottom side. So what do you do now? So the reason that they would be at risk of assignment is only if, or the only time you would be at risk of assignment as a short call option seller is if the call option buyer, so follow me on this, if the call option buyer could exercise their contracts, collect the dividend being paid, and take the money from the dividend being paid and buy a put option at the same strike price as the short call. Does that make sense? Okay. They're going to take the combined stock and long put option, which basically is the same payoff diagram as a long call option. It's the exact same thing. Long stock plus long put, same thing as a long call option, right? It's just like two different ways of looking at it. And they're going to mimic the exact same position, but they would only do that if there was an economic benefit to them. So let's use some like kind of concrete numbers. Hopefully this is helping out. So let's say that a stock is trading at $100 and you are short a call at 105. So the buyer is long a call at 105, right? Now let's say that the stock trades up to like 107, somewhere in there, right? Your call option goes in the money. And a dividend of 50 cents is going to be paid, right? So like, again, just using round numbers so it makes sense. So if you have the 105 short call option and the option buyer has the 105 long call option, conceivably they could exercise their call and be long stock at 105, right? You be short stock at 105. But they want to exercise that long call so they can collect the dividend. They can collect the 50 cents dividend, right? Now here's the thing, right? They would want to use that 50 cents and buy a 105 put with 50 cents, right? Or less, okay? Or less. So if they exercise the stock and they get the 50 cent dividend, but the 105 put is $100, like $1 in option like value, then it's economically inefficient for them to do that because they actually paid money to go through the exercise process and paid money to collect the dividends. Does that make sense? For those of you guys who are tuned in right now, just let me know if that makes sense. Like add a quick comment, takes 2 seconds on your phone because I see all of you in there. I see you like right up here in the top. You can just add a quick comment in there, okay? So if the dividend is 50 cents and the corresponding put option, the 105 put option costs more than 50 cents, there's not a high likelihood that they would actually do that, right? Because it would cost money for them to actually exercise, collect the dividend, and then buy the put option, basically to replicate the same strategy that they're in right now. Now, take the other side of it, right? Let's say that they collect a 50 cent dividend, right? But the corresponding put option to your short call, so you have the 105 short call, the 105 put option is trading for 30 cents. In that case, almost every single time you're going to get assigned stock, every time, right? Because as an option call buyer, I could, if I want to, I could assign the option, buy stock at 105, collect a 50 cent dividend, and then take 30 cents and buy a put option, which gets me into the same position that I was in before, only now I've got 20 cents extra from that put option or from the dividend, right? Does that make sense? Do you guys understand that makes sense? So let me know in the comments real quick, okay? Or with like thumbs, hearts up, whatever you guys, whatever you want to use, smiley faces, don't care. Right? So does that make sense? So in every case, that would actually happen because now I'd be economically ahead, financially ahead after the dividend, and I'd have the exact same risk to reward features, the exact same payoff diagram, right? That makes sense? Okay. I'd have more capital invested because I'm long stock, but like payoff wise for the rest of the month, the rest of the expiration period, I'm exactly the same. Okay. So the rule of thumb is this, and this is what you want to keep in mind as you ever get these assignment notifications, warnings from your broker, right? The rule of thumb is this. If the corresponding put option of your short call. So if you've got the 105 call, the 105 put. If you've got the 110 call, the 110 put, whatever it is, corresponding put option. If the value of the corresponding put option is less than the dividend being paid, you're at risk of assignment. Okay, so value of the corresponding put option is less than the dividend being paid, you are at risk of assignment. That's it. If the value of the corresponding put option is more than the dividend being paid, you're not at risk of assignment, even if your option's in the money. Just because it's in the money doesn't mean it's going to be automatically assigned because of the dividend, right? And so this is what happened last week with people with XLV and XLF, etc., is that everyone had in the money options and they got the notification from the broker, but we weren't at risk of assignment. The corresponding puts were 2-3 times what the dividend was going to be paid. So it would have been economically inefficient by a long stretch for those call option buyers to exercise, collect the dividend, and then try to buy those puts. They wouldn't have done it, right? So does that make sense? So hopefully that helps out today. I know I want to keep jumping in here and kind of talking about these topics, but I think this one was interesting. Hopefully that helps out. If you thought it was good, let me know. Add a comment here or share it. Help us spread the word. Give us some likes and thumbs up. I think next week, and I just want to tell you guys what we're going to talk about next week if you're still tuned in here, or later on this week. I want to talk about later on this week what the best delta is for selling options, why school totally screws you up, because it screwed me up. The importance of recording yourself as an investor. I think that'll be an interesting topic because not many people do it. And then overall portfolio allocations and returns, which is a big hot topic as well. So make sure you get notifications for our live streams and tune in later on. And thank goodness all the girls, all 2 girls were still sleeping. So that's good. That allows me to actually get these things done during the day, which is good. So we'll talk to you guys soon and take care. Happy trading.